Welcome to the High Stakes Financial Playbook. In this video, we will connect the dots between student debt strategy, career burnout, investing decisions, and tax optimization. First, we will frame key decisions like forgiveness versus aggressive payoff. Then, we will address career satisfaction and sustainable saving. After that, we will cover real estate liquidity and when renting beats buying. Next, we will walk through W-4 mastery and the backdoor Roth conversion. Finally, we will wrap up with a victory checkpoint and a concise set of action items. Here is our agenda. We will start with the debt strategy decision, then transition to career burnout considerations. We will continue with young wealth and rent versus buy. Next, we will explore tax tuning via W-4 and the backdoor Roth. We will close with a victory checkpoint and key takeaways, and we will test your knowledge with quick quizzes along the way. This is an educational presentation, not individualized financial, tax, legal, or investment advice. Please consult a qualified professional who can evaluate your personal circumstances before taking action. Let's break down the pivotal debt decision. If you are eligible for PSLF, the mathematics support paying the minimum on an income-driven plan, such as SAVE, to maximize the amount forgiven after 120 qualifying payments. Furthermore, SAVE offers interest subsidies that reduce unpaid interest accrual, which improves the cost-benefit of the forgiveness strategy. A critical tactic is to time your income recertification to the legal windows when you can use prior year lower earnings, such as residency income, to lock in reduced payments for as long as possible. On the other hand, if forgiveness is not on the table, or your weighted average interest rate exceeds roughly 5.5% to 6%, the aggressive payoff path dominates. In this case, eliminating high-interest debt provides a guaranteed return that often surpasses expected market returns. This can justify liquidating some brokerage assets to retire the liability earlier. Overall, the decision centers on eligibility for PSLF, your interest rate, and your expected market return, with a preference for guaranteed savings when interest rates are high. Here is a high-level timeline for PSLF. Initially, verify that your employer qualifies, consolidate if appropriate, and enroll in SAVE. During years 1 through 3, prioritize recertifying using lower prior year income when permitted, and diligently track qualifying payments. Through years 4 to 6, maintain full-time status and submit employment certification annually. In years 7 to 9, audit payment counts and proactively correct any servicer discrepancies. At 120 qualifying payments, submit the PSLF application and receive tax-free forgiveness. Throughout the process, avoid forbearance and deferment where possible, since these can interrupt qualifying payment sequences. Question: if you are eligible for PSLF and enrolled in SAVE, which strategy is typically optimal to maximize tax-free forgiveness over 10 years? Options: A. Make maximum possible payments early to reduce principal fast. B. Pay the minimum required amount and leverage interest subsidies. C. Pause payments frequently via forbearance to save cash flow. D. Switch to a standard 10-year repayment plan. You may pause the video now to think about the answer. We'll discuss the answer in the next section of the video. The correct answer is B. Paying the minimum on SAVE while maintaining PSLF eligibility typically maximizes the tax-free forgiven amount. Higher voluntary payments are generally counterproductive in a PSLF strategy because they reduce the eventual tax-free forgiveness. Now let's pivot to the happiness discount concept. A higher salary often carries higher stress and burnout risk. For instance, compare a $135,000 high-stress job to a $78,000 lower-stress role. Model how much after-tax savings each produces and how long you can sustain it without burning out. A sustainable savings plan that you can keep for 5 to 10 years typically outperforms a short, unsustainable sprint. Also factor in hidden costs of burnout such as healthcare needs, job changes, or forced career breaks. Next, consider young wealth and real estate decisions. If you have a substantial invested portfolio, avoid prematurely liquidating positions for a primary residence down payment. Renting preserves liquidity, avoids transaction costs, and allows your investments to continue compounding. If you are uncertain about location or lifestyle requirements, renting for 1 to 2 years provides flexibility while you gather information and maintain market exposure. Use cash reserves and side income to fund lifestyle goals in the meantime. Here is a mind map to organize the rent versus buy decision. Renting emphasizes liquidity and flexibility, with lower transaction costs and maintenance handled by the landlord. Buying offers equity accumulation, which is slower early on, and comes with transaction costs, ongoing maintenance, and property taxes. Key considerations include your time horizon, job stability, the opportunity cost of interrupting investment compounding, and whether side income can support goals without selling investments. Moving on, let's discuss W-4 mastery. Use a reputable tax withholding estimator to compare projected tax with projected withholding, then compute the gap. Your goal is to approach zero refund and zero balance due by precisely adjusting W-4 entries. Use Step 3 for credits, Step 4B for deductions, and Step 4C for any extra withholding needed. Reassess after promotions, bonuses, job changes, or life events to maintain accuracy. Furthermore, let's address the backdoor Roth. It is permissible to convert small gains that occur in the traditional IRA. Those gains are taxable, but this does not violate contribution rules. The true issue is the Pro-Rata rule, which causes your conversion to be proportionally taxable if you have any pre-tax IRA balances. To avoid this, first eliminate pre-tax IRA balances by rolling them into an employer 401k when available. Then contribute non-deductible funds to the traditional IRA and convert promptly to Roth. Be sure to track your basis and file Form 8606 accurately. Question: which situation most likely triggers the pro-rata rule during a backdoor Roth conversion? Options: A. No existing pre-tax IRA balances. B. A small gain before conversion. C. Existing pre-tax IRA money elsewhere at year-end. D. Funds fully converted to Roth within 48 hours of contribution. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Any pre-tax IRA balance at year-end triggers the pro-rata rule, even if the money is in a separate IRA account. This causes your conversion to be proportionally taxable. Now that debt is gone or minimized, reallocate freed-up cash flow toward your priorities. This example pie shows 20% to emergency reserves, 40% to retirement, 25% to brokerage, 10% to fun or travel, and 5% to giving. Adjust these percentages to match your risk tolerance and goals, and automate transfers to sustain consistency over time. Here is a quick decision toolkit in Markdown style. Confirm PSLF eligibility and documentation. If your weighted average interest rate is above approximately 5.5% to 6%, consider prioritizing aggressive payoff. Ensure your pre-tax IRA balance is zero before executing a backdoor Roth conversion. Tune withholding to approach a zero refund by using W-4 Steps 3 and 4. Remember that guaranteed interest saved often beats uncertain market returns, and aim for an after-tax savings rate between 20 and 30% of gross income. This table summarizes decision leanings by scenario. With high-rate debt around 6.5%, aggressive payoff tends to dominate. With moderate debt near 4%, compare carefully to expected market returns and your risk tolerance. With low-rate debt around 2.5%, investing the surplus often makes sense. If PSLF eligibility is present, the default strategy is to make minimum payments on an IDR plan such as SAVE to maximize tax-free forgiveness. Finally, celebrate your victory milestones. Whether you eliminated student loans or credit card balances, acknowledge the win and reallocate those former payments into investments and other goals immediately. Track your net worth and cash flow before and after the milestone to reinforce progress and maintain momentum. Here are the key takeaways. For PSLF, minimize payments on SAVE and maximize tax-free forgiveness. For high-rate debt, aggressive payoff tends to beat uncertain market returns. Sustainable careers typically outperform short, high-stress sprints. Renting preserves liquidity and allows your portfolio to keep compounding while you learn your needs. Use W-4 Steps 3 and 4 to target approximately zero refund, and ensure you have no pre-tax IRA balances before a backdoor Roth to avoid the pro-rata rule. To wrap up, combine math-first analysis with lifestyle sustainability to make high-leverage decisions. Consider eligibility, interest rate, expected returns, and tax impacts in sequence. Automate positive cash flows once debt is reduced or eliminated to accelerate compounding. Finally, Revisit your assumptions annually and after life changes to stay on track. Thank you for watching. If this was helpful, please like, share, and subscribe. Leave your toughest money question in the comments so we can address it in a future video.